Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, September 8th, 2020. I hope everybody had a nice long 3-day weekend here in the U.S. With the Labor Day weekend. Hope everyone else elsewhere had a nice weekend as well. Back to trading now, and I wanted to just go over a few charts and talk about the outlook on the markets, both near term and intermediate term. I always talk on, I wear different hats personally and try to provide analysis for both active traders, that's the very short term, hours to days, and then also the intermediate and longer term for investors and typical swing traders. That can be, where what we're going to talk about here is where the market's likely to go in the coming days to weeks to maybe even months, but let's just focus right now on the very near term and intermediate term. Okay, just to kind of recap, if I know some of you don't check on the site every day, there's new people coming in. What I've been highlighting in recent weeks here were the extremes that we hit in sentiment, and I like some of my favorites are the put to call ratios. This is the total put to call ratio, CPC, and we had a cluster of multiple tight readings. You can see that red line there. This is the 50-day EMA, or simple moving average, I should say, hit this extreme low right here as well. That's something I watch, and that's what you're going to get when you have persistent low readings. That came down really low. We saw it down around that level back here, and again, you can see all the boxed areas when you get these. Either once in a while you'll get a single reading, but usually it's a double or triple tap, or sometimes 4 consecutive readings in these clusters. So that was what was going on. I mean, we could see it in the market. Sentiment had just gone extreme. There's the what I believe to be a false belief that the Fed will indefinitely back the market, or certainly try to, but whether they're successful or not, either way, things got ahead of themselves for the very near term. And as history shows, those corrections that follow are usually measured in double digits, pretty big drops. In fact, most of the drops of the last, even up to the previous bear market, were all preceded by those drops. So that's one thing. And now the reason I'm hitting on this again is it helps to paint the bigger picture where we're going in the coming weeks, because again, usually when you come off such extremes here, that you have some imbalances in the market, with everybody being bullish and long and buying a lot more call buying than put buying, and that is what needs to be cleared out. And again, those corrections usually end up taking weeks and measured to the double digits. So I don't think this one is over yet. And even better than the CPC is the CPCE, at least as far as accuracy has gone with those signals. Going back again, I have the red line right there at about 42 or so, and without fail, you can see all of the tags to that level for the past decade, over a decade. And we had this again, a tight cluster. I should have put that third circle right there, and you can see these were big drops. These were the biggest, or a couple of the biggest drops in the last bull market there. That one again, I think, was about 10%. And like I said, persistent low readings there. Look at the 10-day moving average all the way down to about almost to the 40.45 level. We haven't even seen it this low throughout the last bull market that started back in 2009, and technically, if you want to call it that, ended there. I think some might say this is just a continuation of that. I think the old metric or measure of a drop of 10 or 20% or more being a bull or a bear market, if it rises 20%, that's old school. That's 1930s stuff to me. So now you just kind of look at the chart and know that what the Fed has done in recent years, all the global central banks, is they've just increased volatility. The large move up, they supersize the last bull market, so you have these what I call supersized corrections along the way that can measure 20-30% or more. And again, it's all semantics whether this is a continuation of the last bull market. Many indexes have not, and a lot of the equal weighted indexes have not made new all-time highs. It's mainly the tech heavy NASDAQ 100 and a couple other things that have. Okay, So that was just to kind of lay out, the most probable outlook for the coming weeks here, maybe even a few months, with again more downside than just what we saw in the last few days. This is a daily chart of the SPY. Just wanted to kind of hit on the key points. I'll talk fast because this is all stuff I've covered recently. There's our primary uptrend line. I've been waiting forever and a day to give a sell signal in the markets to have that break all the way since back here. And we've just kept inching higher, higher, higher. We had some short-term breakdowns on the intraday charts, 60-minute charts, things like that. Sell signals that didn't really pan out for much more than a 2, 3, 4, 5, 6% pullback. But this, starting last week, with I'll call it the Apple, Tesla crescendo, if you will, with the those stock splits and retail crowd piling in, that seemed to mark the top last Monday, and nothing but selling since then. And so to kind of recap what happened is, on Friday, we closed below the trend line on SPY after a pretty nice intraday break, but we rallied back up to relative close proximity to it. However, right now we're trading comfortably below that. So by all accounts, and with 2 hours left in the trading session, anything's possible. We're probably not going to regain it. So I'm going to say sell signal has been triggered on SPY. It was technically triggered on Friday and follow through today. And again, if we don't regain that trend line soon, that's going to be bearish. The other things, I'm going to loop back over to the futures and QQQ in a second. But to me, probably two of the most important things to watch right now, I think, are Apple and Tesla because of those stock splits. As I talked about, the retail crowd is known for piling into stock splits. Institutional investors, it doesn't matter if Apple's selling for 130 a share or 800 or 1,000 a share. They're buying in very large quantities. So it's the retail crowd that gets all excited and jumps in, and that's what's to a very large part has been driving this market in recent months. And so what I'm watching is, where Apple and Tesla split. There was a little follow through. People were buying Apple the day of and after the split, and then Wednesday it hit that was it, and it reversed. We put in the bearish engulfing candle right here. That was last Wednesday, and that candle has been confirmed. I always say that bearish engulfing candles in themselves are technically a sell signal or a potential reversal stick, and that's a key word, a reversal stick that is usually good for a pretty decent correction. But I like to see the follow through selling, and we had certainly a big red candle on Thursday, and then we technically closed green Friday because we went down way below Thursday's low, but we rallied back up just a hair above Friday's low, and now we're back below it again. So I want to say this is confirmation so far to that bearish engulfing stick, and the technicals work. It would say there's more downside. And back to what I was saying, I think all here, this is that post-split buying right there. That would be, I think, very bullish if the Apple and Tesla can regain those levels last week and get back above there. It will show all those that rode out and didn't get shaken out yet through this, that buy and hold, and the market's just going to keep going up, 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 and I think you'll bring in a new set of buyers, unless we just had a marginal pop, a brief pop, and then a lot of selling, because that will also show you that, hey, maybe all those people that bought it, without a doubt, we don't have to have a master's or a doctorate in psychology to tell you right now that the people that chased or bought the stock split or resented it and are feeling the pain. I mean, that's just a given. You can just see from the drop from the post highs right there. It was about, let me just see, into yesterday's or Friday's lows. That was about a 20% drop, 19% right there in Apple. Okay, so again, a lot of pain being felt by those that bought the split, thinking the stock can only go up from there. So, point being, if they can regain that level, and power on through there, that's going to be pretty darn bullish. But as of now, there's probably a lot of trapped sellers, those that were panicking last week but didn't pull the trigger and say, wow, I guess this stock is not impervious. And so as we get up there, let's see how many step in and sell once they get close to even or break even right there. That'll be interesting to see. And it's also going to be, and again, there's some technical levels up there as well. And then Tesla really took a wallop. Tesla from the split. There's a split right there on Monday, and peaked Tuesday the next day, and into today's low so far. That stock is down 33%. It doesn't look like it here because I use log scaling. If you turn off log scaling, you see a different story. 33% drop. That's pretty big for I think just about anybody. And so again, quite bullish if this if market and Tesla can shrug this off and power back up, but I don't think it's going to happen. There is some technical damage done on this stock as well. You can see it below trend right now, at least the way I have this trend line drawn. So that's it. Longer term, I think we go down more. Where do we go? Well, that's why I'm doing the video. Let's get back to the charts, but let's also talk near term as well. Let's talk futures, and I want to talk about those 60-minute divergences. I pointed those out last week. They continue to firm up. They've gotten larger. In other words, they haven't yet been negated or taken out. Let me, I have to toggle over here. I have to do something real quick so I can zoom back to the time frame I want. Go back to an hourly. And so this is it on QQQ, or I'm sorry, NQ, the NASDAQ 100 futures. There was our 60-minute uptrend line, which was broken. Same as that daily uptrend line on QQQ. There was our sell signal right there given last week. That was so far a golden shorting entry right there. If you took the breakdown in the NASDAQ 100, had that little flagging type action. Didn't play out to the full length of the flagpole. Started going up, but actually now might have hit the full length. But again, that's not typical bear flag action. You usually see an impulsive move down, flagging action, and then an equally impulsive leg down. But what I can say with confidence is that we fell to, and so far have successfully tested that 150-ish support right there. We had a test on Friday. And we did have, I pointed out in the closing video, we had positive divergence in place. It was confirmed, and it did lead to a bounce. That's the bounce we got. And we took another jog down. What it didn't do is, number one, it didn't take out that same support level that it held on Friday. So far, we've held it. Doesn't mean it's going to continue to hold, but right now it's held. And it also put in an even larger, what I call potential divergence. Need to see the PPO curl up here. Right now, the PPO is pointing lower, and it is a momentum indicator, so we could continue lower. And I'll just pull these divergence lines like this until they no longer exist. Meaning, if we go out and take out this previous low right here, the divergence will no longer exist. Same with the RSI. So as of now, I'll leave the lines here. I'm watching for a bullish crossover in the PPO. If we get that, that would certainly, that in itself is typically a bullish event. Usually after a 60-minute bullish crossover in the PPO, you get some upside. And where would it take us? Well, let's just right now say a back test of the trend line. It would almost be too easy, too obvious, but that's the technical level, and there's price resistance just below it at about 727.90. So let's just say, and I'm still leaning this way, but not gung-ho. I mentioned it this morning in the update that I am near term, and that's just hours to maybe a few days, near term cautiously bullish. So it's not an all-in. I have super strong convictions because, again, what happened, what I led with, what happened with these extremes that we've hit recently in sentiment and positioning. Everybody long, hardly anybody short, shorts being blown out and given up, and that's what usually leads to those pretty impulsive drops, and you get the, pretty much relentless selling on all the little bounces. And so far that's been the case. Every time we've had a little bounce, it gets sold into and we make a new low. This is what's going on price-wise. A series of lower highs and lower lows. That's a downtrend, make no mistake about it. However, I put a lot of stock into these divergences, especially on the 60-minute time frame. It'd be a little better if we could see it on the QQQ and SPY. We have some RSI divergence, but not the PPO divergence yet. But with that being said, that could easily be the catalyst for a rally up here to that level, the 720, well, about 728, and or back test of the trend line. So let's just list those as potential bounce targets right now. Let's look at ES, and I'll get to SPY and QQQ, or yeah, SPY, QQQ, and IWM for you ETF traders in just a second here. If I can find my ES, here we go. ES 60-minute chart. ES are the S&P 500 futures. Here you had on Friday a small divergent low right there as I'm coloring in, and that led to a good bounce. That's a tradable bounce, and this is what I talk about. And again, the difference of an active trader, a nimble trader who can game a bounce like that. What is that good for? That was good for about a 3% pop in the ES, which is a great trade all day long, and that's active trading. And it rallied right back into that 3447 resistance level, and then we went down. We made a marginal new low. And should we go any lower today, we still have support because we reversed just shy of that 33.25 support right there. And so again, these are what I call potential, not confirmed divergences. So should we, let's take a late day jog, or maybe tonight after hours or tomorrow morning, hit that level, we could still reverse with positive divergence. If we take that out, the next level below it is 3283, 3282 or so right there. And if it happens soon, it all depends on when it happens, you could still have the divergence in place there. And that's a pretty decent support level as well. So again, the risk reward right now for shorting, especially adding new shorts, is not very good. Again, if you're nimble and active and you want to game a bounce, I think the opportunity might be there to get a quick bounce. Let me show you something else on SPY and QQQ daily charts here. One thing I like to look at is the RSI. So we're on SPY right here. I'm going to expand the RSI a little bit down below. And what you can see here is we're coming off an extreme overbought reading. That's a circled area right here. You can see the RSI at nosebleed levels. I always say this, oversold in itself is not a sell signal, because the problem with that is oversold can become more oversold or stay oversold for an extended period of time. But it is certainly increases the odds of a correction when you become very overbought. I might have said oversold a second ago. Same story, oversold can become more oversold. But overbought, again, sometimes it doesn't play out for much. You just continue to become overbought. And then finally, especially if you can get a divergent high like that, when you had negative divergence right there, and that's what played out for the big drop. There was an overbought reading. It was one and done, and it was one of the biggest drops we had since the March lows right there. And here we're overbought, but we've been overbought for a while, and it finally played out. So again, the catalyst, you don't see it here, was that breakdown that I highlighted early last week on the 60-minute time frames on NQ and everything else, and that was it right there. And but what I did want to point out, going back to the RSI, I'm getting off on a tangent here, is the 50 level. The 50 level is a midpoint. RSI is a bounded indicator. That means that 0 is the absolute minimum theoretical value. You don't get down there, and 100 is the high end. Whereas the RSI is not a bounded indicator. There's no top or bottom number. It all just depends on where things go. So anything 30 or below is considered oversold, and 70 or above is considered overbought. And the 50 line is right at the midpoint, because again, it's bounded between 0 and 100. And so what I've noticed over many years is that midpoint often acts as support or resistance when you hit the top or the bottom. So in other words, you were overbought here, you pulled back, 50 was support. You were overbought again, pulled back. It doesn't have to be exactly 50. We're talking a few points, give or take, 47, 52. Well, and if you take it out, then usually you're going to go down to the bottom. So again, it's been support or resistance. You can see here on the bounce back. We'll go back here. You bounce back to the 50 level, and we were rejected. Here, you hit oversold. You bounce back to 50. Test it. Finally, you broke it. You broke support, and you rallied up for a while. And there's another pullback, capped at the 50 level. Another pullback. A little sloppy, but it went through there and it held, and then you bounced. Then you finally took it out and you went all the way down to oversold. Here, you've regained it, and look, support, and that's where we're at right now, a little bit below, just like this reading here. So I wanted to point that out, that you have the S&P 500 as well as QQQ. QQQ slightly below it, a little bit more than slightly, I should say, to be accurate. But it is sometimes you do overshoot it just a little bit and then hold that level. And again, with the S&P 500 there, maybe the SPY buyers step in. But again, you can see that 50 level, how it often acts as support when tested from above, resistance when tested from below, and it's not always exactly right on that level. But again, you can see enough reactions. There's one that spiked a little bit above there. So if the Qs can reverse now. That would be just a little momentum fueled overshoot of it, and you could get a rally. Where would a rally take us? I'll zoom back in. Like I said on SPY, we have a sell signal triggered on that long-awaited break of the trend line right there. QQQ, as I covered in Friday's video, did not break, or I should say did not close below the trend line on Friday or last week. Closed right above it. So the Qs did not have a sell signal. However, they are comfortably below it now, and with about 2 hours to go in the trading day, unlikely to regain it today, although anything is possible, and that's why I said earlier I'm very curious to see how the market closes today, particularly the tech-heavy NASDAQ 100. 275 is price support as well. There was support, it's resistance now. So if you can get above 275, that helps. And again, an objective reshorting exit level, I should say, or an objective level to unload some longs, and a bounce target would be a back test of the trend line. Just keep in mind that back tests sometimes are one and done, meaning like that, and sometimes you back test and you keep back testing for a while and then get rejected. Obviously, if they can regain that trend line, I don't think it's going to happen, but that would certainly be a near-term bullish event. And then again, a lot of traders trapped up in here last week with the Tesla and Apple splits, and then got smoked. And as the market usually does when it wants to trap people like that, whether trapped shorts after an extended downtrend on the bottom, and you get a V bottom like that, same thing happens on the top. It tends to happen very fast, and it does that to not allow those that are working or not full-time traders. They come home, they think they were going to be fine on their Apple and Tesla, and they just realize, wow, I'm really down. Oh, I'll just wait for the first bounce. Then you have the follow-through selling, and that's what causes these big drops like this. It's trap longs. It's one-sided trades when everybody's bullish, and again, I'm speaking metaphorically, not literally, but when the majority of traders are bullish and long, everybody has bought his or her last share, and there's nobody left there to buy on the dips, and so you have these kind of sharp move down. So I cannot rule out just additional impulsive selling, and I want to make it very clear. I'm talking about the near-term bounce scenario with those 60-minute divergences on the future, but right now, from a daily chart, and if I'm speaking to less active swing and trend traders, these are sell signals, and at this point, you shouldn't be worried about trying to game a counter trend bounce. If anything, you have sell signals, you'd be looking to short on a bounce back to resistance, those objective levels. Or add to your shorts if you are already short. Okay, and what's tempering my near-term bullishness, like I said, I was cautiously bullish just because of 60-minute charts. What's tempering that is I don't see enough fear in the market. Apple, Tesla, what's happened there? There's a solid breakdown in the semis. I'll get to that in a second. Like I said, there's a lot of charts. So much going on in my head right now. I'm watching so many things. But the VIX, look, we're profitable in this trade. We had a very timely entry. Buy trigger above 26.89. I'm trying to zero in. So far that trade was good for, I don't know, almost 30% into Friday's highs. But here's what I'm getting at. This is not commensurate with what I'm seeing on the chart. It's a lift in the VIX, and I'll take it for what we've got so far. We hit our first target. But we're not seeing excessive fear. And I just showed you I started out with the put to call ratios, the CPC and the CPCE. I'm seeing a lot of non-believers. In other words, the bulls aren't buying this. And that to me says, you know what, it ain't over. If I saw a surge in the put to call ratio, if I saw a surge in the VIX, maybe if we went up, hit T2, T3 last week where we were, or even today with the markets being down as much as they were, I'd say, you know what? A lot of people have turned around and bought put protection on their positions because they're worried, and that's going to put a near-term floor in the market. We're not seeing that. So this chart alone in the CPC and the CPCE speaks to more downside to come here, whether or not we get a little bounce. And we did have a little bounce. Let me clarify that too. I mean, we look at SPY today. We look at here. This is a 1-minute chart. Off today's lows was right here. That was we had a bounce so far. It was this morning. It was good for about 1%. QQQ rallied as well off the lows right here. This is this morning. Good for about a 3% bounce. So, those are tradable bounces all day long. And that's what I talk about, a tradable bounce. If you're an active trader and you get, a 0.25% on a contract for NQ, especially a 1%, 2, 3% gain in a day, that's going to put thousands of dollars in your pocket as an active trader. So we've had the bounce, and it's as I'm doing the video, it's being faded. So again, and I think that's just because there's not enough fear. There's too many non-believers right now on what happened last week, and that doesn't bode well for the market until we get at least a near-term washout and a little bit more fear coming into the market. Okay, so back to the futures. All right, there's NQ, NASDAQ 100 futures. I think I already covered it. Potential bounce targets if the divergences do play out. Let's see, ES. I think I showed you that already. Same thing. There's your divergences, potential bounce targets up here, all the way to 34.47 to 34.83. Downside targets, like I already showed you, I believe I said the next support target, and if we dump today, we might get that later tonight, is 32.82. And I have to zoom out here a little bit and go back a few more, another month or so here. You can see, or I can see, just kind of glancing at this chart, that's the one I just mentioned. The 32.82 comes in pretty decent support, and then you can see a lot of reaction highs right here. So this would be a near-term target zone all the way down to those levels there, about 31.75 to 31.90, somewhere in there. And something else I can see when I look at, here's a reaction low back here. I'm going to move that divergent low label right there, and I'm going to put a trend line for you right here. Come in and catch that next low, and puts us right about where we're at right now. So what I did is a trend line again off the bottom there, and coming in, catching this next low, and a potential. This is what I call a potential trend line. Why? Because in my book it takes 1, 2, 3 reactions to validate a trend line, because any 2 points, 1, 2, can be connected at random. So if we get a reaction here, that'll help validate, and we might have a new trend line setting up right here on the ES 60-minute charts. But as of now, we haven't consolidated, and we certainly haven't bounced off it enough to say that. But it's a possibility. RTY looks interesting. Let me get to the small caps and we'll wrap it up here. All right, I have it over here somewhere. There's RTY. Okay, RTY triggered a sell signal and an objective short entry a while back. It was in early August, over a month ago. Yeah, about a month ago. Right here on the 60-minute chart, we had a breakdown there. And what happened is they wouldn't stop buying the tech stocks. So NQ, the NASDAQ 100, continued to hold the market up, and pretty much, the entire market with just those tech-heavy, FANG names, Tesla, NVIDIA, and so it played out, but slowly and finally, and I think I mentioned back here, if it took out that level, which it did, we would go on to move down and hit the targets. And we had reactions on each of these targets. I don't believe I've modified these. So it took a while, but we hit our 1536 target there last week. And then on Friday, we hit my 1494.30 target right there-ish. Remember, these are unadjusted targets, the actual resistance or support level where reaction is likely. And what does that mean? Well, if you're trading off that, since I didn't make an adjustment, you always want to step in and cover a little bit early. I like to cover a little bit before support level that I'm targeting in case the buyers happen to step in early if too many eyes see it. But I want to point out we hit it again today, and in doing so today, which we didn't have last week, we put in on the small caps positive divergence right there. So not only did we hit that target, we did it with positive divergence, and that could also set the stage for a rally into, it's getting late today, but certainly this afternoon if it pans out, and into tomorrow, maybe throughout early this week. Potential bounce targets, it's kind of sloppy up here. I would tell you probably the most solid level right now is that 1589-ish level right there. We've had numerous tests on that level since the breakdown. So that would be max upside bounce target. Next target, I believe, when I first listed this as a sell signal and listed these targets, I think I had this as my minimum swing target down here. One of these, I think it was 1424. I'm gonna have to revisit that chart, that post. But so I think it's more of a, do we do this or this? Leaning this way right now, still leaning that way. There it is. It was a 60-minute chart of IWM I gave you a few weeks ago that I listed that target. Okay, so there was our sell signal right here. We broke this 60-minute wedge, sell signal triggered. We bounced along that 156.23 support for a while. We broke it. We back tested it for a while. Did whatever we did there, a little whipsaw signal, but we stayed below the breakdown right out. Back tested pretty much the breakdown point right here, and then went on to hit my 152.12 support target, and then 149.26 target. Hit on Friday, hit it again today. Again, you see a little RSI divergence, but you don't see the PPO divergence here on IWM. Why? Because IWM does not trade around the clock like the futures do. So the futures, you have more price points, more candlesticks. So that's where you can sometimes pick up those divergences. Now, if we get the divergences here on the 60-minute charts, all the better, of the indexes, the ETFs. We don't have that yet. So I wanted to say, and without mixing any words, I still maintain this as my current minimum preferred swing target. And again, it's just a matter of, do we do this or do we do this? And slight odds going to this right now, but certainly a possibility, especially considering the fact they're not scared today. The VIX isn't rallying as much as it should be, I think, for as much as we're down, especially in the tech stocks. I know the VIX doesn't track the NASDAQ 100. It's the CBOE volatility index, and it's measured, it's more, let's say, closer to tracking the S&P 500 or the broad market. But they do have their own volatility index for the NASDAQ 100. That's VXN. Here, we'll look at that real quick, and you can see what that's doing. Again, it's not, I have a delayed quote on here right now, but it's down today. So I'm just not seeing the fear coming into the market based on what's going on with prices right now, especially the breakdowns there. All right, I think I'll wrap it up here. I was going to try to get to gold and silver. I'll cover that in another update. They're kind of holding those same levels. Silver's right at trendline support. Gold was a hair below with some 60-minute divergences. Gold's going to help to try to catch a flight to safety bid, but the cross currents are still a bullish outlook for the dollar and near-term bearish outlook for gold. I'm still longer-term bullish, but near-term looking for a little more downside. One other thing to mention too, we might get some forced margin cost selling as well, which could give us another impulsive leg down this week. I know Interactive Brokers just sent something out last week. They're as they often do, once the volatility spikes after these extended periods of low volatility, they're tightening up the margin requirements. And what that means is those, and we know this isn't my opinion, this is fact, after an extended rally like this with just all fundamentals thrown out the window, just a crazy overdone persistent rally, that the majority of traders are long, not short. That's just a given at this point. So therefore, by using that deduction, if they're long, those that are maxed out on margin, those that have been buying Apple, buying the dips, and it works, buying Facebook, Amazon, Microsoft, Tesla, if they were long on margin, meaning borrowing money, put in $100,000, your broker will let you buy $300,000-$400,000 of stocks. If margins get tight and you're already going down, let's say you again use that, just pick a number. You put in $100,000 in an account, you bought $400,000 of Tesla. Well, your account value is chopped down by a third right now because Tesla's dropped 33% since the split or shortly after. And so then you're faced with margin calls, which you're forced to sell what you own. If you don't sell it, your broker will. And so you get that forced selling, and that's what leads to these quick drops. That's what led to the drop there. That's what led to the big drop in the fourth quarter of 2018. Now, take it a step further. I don't know if any other brokers are going to follow suit, Fidelity and Ameritrade and all those, but when they tighten up margin requirements, then you're going to get margin calls if you're even close to being at your limits there. So and again, that can lead to a vicious cycle of selling As the farther the market drops, more and more long side traders get hit with margin calls, and they are forced to sell what they have. And again, if they don't do it, their broker will. All right, so that's it. I just want to talk about that kind of stuff. And yep, near term, like I said, the charts remain constructive right now for a bounce. I give you potential bounce targets. Look at these back tested trend lines, overhead resistance levels. And if we continue down lower, I still maintain these targets on QQQ that were laid out back here right before the sell signal was triggered. We hit my first target zone there, went through it, hit the second target, trend line. Third target was hit here, and we've been bouncing around that third target. This is still the fourth target, and a potential fifth target zone, which I have more confidence now that will be hit. So that's just, let's call it T5 zone. And again, to me, it's a matter of this or this, with a slight favor towards something along these lines right now, the bounce scenario, and then another leg down. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.